How to avoid paying taxes on crypto. Cryptocurrency is one of the most talked about issues in the financial world right now, and for good reason. Statistics reveal that crypto investors made considerable profits in the early stages of the technology's development, despite the fact that it is a volatile market. A lot of people have made a lot of money by purchasing and trading virtual currencies over the course of the last few years, and we've certainly seen that trend continue. Perhaps you've already made a purchase of cryptocurrency of your own. If this is the case, you'll need to figure out when the best time is to cash in on the Bitcoin bonanza. You should consider how you will deal with cryptocurrency taxes before you get to that point, however. That's true, if you sell for a profit, you get to keep the money. Obviously, you want to reduce your cryptocurrency taxes so that you may keep more of your money and maximize your benefits. To do so, you must first understand how Bitcoin gains are taxed. Then you can consider measures to lessen or eliminate your tax bill. Hopefully, the information and tips provided below will assist you in keeping a lid on crypto taxes and allowing you to get ahead financially. What are crypto taxes? For federal income tax reasons, cryptocurrency is considered property. And, for the average investor, the IRS considers it a capital asset. As a result, crypto taxes are the same as any other gain realized on the sale or exchange of a capital asset. When you buy a capital asset, such as a stock, bond, property, widget, Dogecoin, Bitcoin, or other investment, you establish a basis equal to the cost of acquisition. When you sell anything, you compare the sales proceeds to the basis to see if you have a capital loss or a capital gain. You have a capital gain if your proceeds surpass your base. If the situation is reversed, you have a capital loss. You must also evaluate the time period in which you held the asset. Your earnings or losses will be classified as short-term or long-term depending on how long you hold your Bitcoin. This distinction will also have a significant impact on how much crypto taxes you must pay. Short-term capital gains and losses. When you buy and sell an asset within 365 days, you incur a short-term capital gain or loss. Short-term profits are taxed at the same rates as regular income, which includes earnings, salaries, commissions, and other earned income. In 2021, the IRS has 7 tax bands for regular income ranging from 10% to 37%. Long-term capital gains and losses. If you purchase an asset and then sell it after a year, the difference between the sales price and your basis is your long-term capital gain or loss. Because the rates are often lower, you'll pay less tax on a long-term gain than on a short-term gain. Long-term capital gains are currently taxed at 3 different rates: 0%, 15%, and 20%. The rate you pay is determined by your income. How to avoid crypto taxes. Now that you know a little bit more about crypto taxes, which are actually just another way of stating capital gains taxes, you'll want a set of techniques to help you pay as little as possible to the IRS. Here are some helpful hints for lowering your tax bill. Hold until your short-term gains turn into long-term gains. As previously stated, different capital gains rates will apply based on the length of time you held cryptocurrency. Hold your cryptocurrencies long enough to convert short-term gains into long-term gains if you want to reduce your tax burden. It won't be easy, but if you have the patience and courage to hold your cryptocurrency for at least a year before selling, you'll most likely pay a lower tax rate on any capital gain. Offset capital gains with capital losses. Another method for reducing the amount of tax that crypto investors must pay is to offset capital gains with capital losses. This works by deducting taxable gains on cryptocurrencies or other investments that have risen in value from losses on crypto assets sold throughout the year. However, be aware that this method has limitations. When you recognize investment losses, you must first offset similar losses. Short-term losses, for example, reduce your short-term gains first, whereas long-term losses reduce your long-term gains. Following that, if you have net losses of either kind, you can use them to offset the other form of capital gain. If you have surplus short-term losses, for example, you can apply them against any remaining long-term capital gain. If you still have a net capital loss, you can utilize it to reduce your taxable income. However, you can only utilize up to $3,000 in capital loss to reduce your ordinary income in any 1 year, if you pursue this plan. The remaining amount is carried forward to the following year and can be used to offset future profits, or reduce your regular income by up to $3,000. Sell in a low-income year. Selling during a low-income year can save you money on taxes on both short-term and long-term gains. If you have short-term profits that are taxed as ordinary income, you won't have as much extra income to put you into a higher tax band. For example, if you retire and sell all of your short-term assets, your tax rate could be solely based on the income from your short-term profits. If you have long-term capital gains, a lower overall income for the year may also result in a lower tax rate on those gains. This is because the long-term capital gains rate that applies to you, either 0%, 15%, or 20%, is determined by your taxable income. As a result, if you have less taxable income, you are more likely to pay a reduced long-term capital gains tax rate. Furthermore, if you opt to retire early and have saved enough money to cover your living expenses, until you can withdraw funds from your retirement accounts, you may have little to no income during the year. If this is the case, now is an excellent opportunity to lock in long-term capital gains and potentially pay a 0% tax rate. Reduce your taxable income. Another tried-and-true tax minimization approach is minimizing your taxable income, which is closely tied to selling your appreciated investments in a low-income year. This entails studying the tax code for tax breaks and credits that can reduce your taxable income. You can, for example, pay for costly medical operations, contribute to a traditional IRA or 401k plan, fund a health savings account, or gift cash or property to charity. There are numerous more tax breaks and credits that you may be eligible for. You might even want to consult with a tax professional to see if there are any other tax benefits available to you. Invest in crypto in a self-directed individual retirement account. Investing in a tax-deferred or tax-free self-directed individual retirement account is another way to reduce your crypto tax liability, STIRA. As a result, you either pay taxes later when you may have a lower taxable income in retirement, or you pay taxes upfront when you contribute to a Roth STIRA because you anticipate paying higher taxes in retirement. Donate your appreciated cryptocurrency to charity. Similarly to gifting appreciated cryptocurrency to a family member, you may want to consider donating your cryptocurrency to charity. Not only will this result in no capital gains tax, but it may also result in a substantial tax reduction that you can claim on your tax return. When you donate an asset, you can deduct the asset's appreciated fair market value at the time of donation from your taxable income. For example, if you hold $50,000 in Bitcoin and decide to contribute it to a charity that you usually support, you may be eligible to deduct it as a charitable contribution on your tax return. Furthermore, if the charitable organization is a tax-exempt 501(c)(3) organization, it will not be required to pay capital gains taxes when it sells the donated cryptocurrency later. However, because cryptocurrencies are highly volatile, depending on the virtual currencies you own, they could skyrocket or plummet at any time. If this occurs and virtual currencies skyrocket, your heirs' tax burden will be lower because they received the tokens on a stepped-up basis.